Good morning, ladies and gentlemen. Well, while last week was mostly backward looking, because let's face it, we all knew that the Fed and the ECB would do what they did, with a slight proviso the Bank of Japan was a slight surprise. This week is actually going to be forward looking because we get the QRA and the funding size and the composition on Wednesday. So from now on, we're getting new data, and that is going to be quite determining as to the shape of the yield curve and what the individual tenures in the bond market do, and that actually is going to drive the equities one way or another. So let's have a look at what's happened and what is likely to happen this week, depending on the QRA announcement. First of all, let's have a look at the slight surprise from the Bank of Japan and what its implications are. Now, first of all, they did not move the level at which they buy tens from 0.5 to 1%. What they did is move the upper limit to 1%. So what they're saying is that 10-year notes will not trade through 1%. They will buy unlimited quantities at 1%, but they can intervene and buy at any level between 0.5 and 1%, which basically means that if you start shorting JGBs at 0.58 and they come in at 0.59, like they could, we're going to go straight back down to 48 in a hurry, and you'll be out 10 basis points before you can blink. So that is why the market is not really going to attack the 10-year JGB that hard for quite some time. It gives you a trend, but it doesn't give you an immediate trend. What you also have to remember is that JGBs swapped back into dollars are actually the way you have the most pickup of any market in the developed world. So JGBs are the cheapest 10-year, the most yielding 10 years. How can that be? Well, it's very easy because they have a positive yield curve while the US has a negative yield curve. And therefore you get a pickup by buying JGBs and you pay away money to own 10-year notes. And that gives you the ridiculous situation that something which is yielding you 0.57 is actually much better than something that's yielding you 4%. There's about a 42 basis point pickup in owning JGBs, which again means that JGBs will not be the thing that is attacked, but the thing that probably gets bought the most. Now let's have a look at what the Japanese yield curve looks like. And these are now the twos. As you can see, the twos have been stuck in between, let's call it 0.7 and minus 0.1 for a long time. That's a 6 basis point range since the beginning of February. That tells you all there is to know about the 2-year note, i.e. it's going nowhere, it's trading in a 5 basis point range. And then you have a look at the 5s. The 5s are trending still lower, but basically between 18 and 5. So that's a 13 basis point range. And now let's have a look at the 2s 10s. And as you can see, the 2s 10s are making new lows, and that gives you the trend. The trend is for a steeper curve i.e. a more positive curve in Japan, but it's not going to be by much. So basically this is around 40 basis points and this is 58 basis points. So it's an 18 basis point pickup. Well, you can contrast and compare to the 2s10s in the US. And that is why I think that if Japan is the cheapest or the best yielding 10-year that you can get out there, what are you hoping for by buying US Treasuries? Why would you buy US Treasuries at a very, very negative term premium when you can buy JGBs and achieve a 40 basis point pickup? Now, as I've said to you on Friday, this isn't a timing mechanism, but it gives you the background. What is the timing mechanism is what's coming this week, and that is the QRA. So we will know how much we need to fund on Monday, and then on Wednesday we get to know the composition of that funding, and that is going to be key. Right, so what are we expecting from the QRA? New money, which comes out on Monday. We're expecting about 525 billion of issuance, i.e. new money which has to be raised. That's including the 3 months of 60 billion each, that's 180 billion that the Fed QT is, that has to be returned to the Fed. So a total of around 525 billion of new issuance, including the 180 billion for the Fed. So then react on the first ball because we have to drill down into the number that's going to be announced to see if it includes the QT or not. But including the 180 billion is going to be 525 billion. Of course, the greater amount of 525, the more pressure on the whole curve. Why? Why the whole curve? Well, because we don't know yet what the composition of that debt will be until Wednesday at 3 p.m. when they announce the how much is going to be in bills and how much is going to be in coupons. For the past, 2 quarters, let's say, the market has really been starved of duration, i.e. a lot fewer coupons have been issued rather than treasury bills. But that is likely to slowly change. Why? Well, the reasons for it are quite simple. The Treasury's checking account has been refilled to the 500-600 billion that they want. And it was quite reasonable to do that mainly through bills. But now it's beginning not to be so reasonable anymore. Why? Because the Treasury is not a market timer in the way it issues. The Treasury does things predictably, or it should do things predictably, and it has done things predictably. And I don't think that Janet Yellen really wants to change that because it injects volatility into the bond market. And that's not good for the long-term funding of the deficit. So I expect that she will be reasonable and she'll start decreasing the amount of bills and increasing the amount of coupons. Now, what does the market expect in terms of coupons? And you can see that by reading the research from JPM, which I post all the time. And the market is expecting somewhere around 225 billion worth of coupons for the next quarter. Now, it could be that the deficit is considerably larger than the 525 billion that the market expects, or is sort of expecting with a little bit of leeway one way or the other. But if coupons now start being much more than 225, and they could easily be if the deficit is higher, then we could be starting to talk 250, 275 billion of longer term duration, which I think the market is going to be uncomfortable with, and it's going to start moving the yield curve. Now let's have a look at what is likely to happen on the announcement. 2-year notes are now really stuck. Why are they stuck? Because some people are expecting that we've already had the last hike. I know the dot plots imply one more hike. But what is the 10-year note going to do, the 2-year note going to do between now and the end of August? Well, when the data is cold on the economy, it's going to be doing slightly better, i.e. it's going to price out a little bit of the tendency it has to discount a hike coming in September. And when the data is hot, i.e. stronger economy, it's going to price in a little bit more probability of a hike in September. But it's not going to go to 100% hike. Let's say that now we are discounting 7, 8, 9 basis points, 10 basis points of the hike of a total of 25. Well, when the data is good, is going to come down to 2, 3, 4 basis points, and when the data is bad, it's going to go up to 15 basis points. So we're talking about a range of, 10, 15 basis points either side. So we're stuck in this 10, 15 basis point range, and we are there, right? So we could go up to 502, maybe 508 and stop a few people out but come back. Or go down to 475 and then bounce off it. So the twos, the volatility of the twos should really start coming down. Completely different in the longer tenures. Because if now you start getting a much higher QRA and you start discounting much larger auctions coming out in the third quarter. I mean, if we get more than 225 billion of coupons, then 5s, 10s and 30s have to start going up relative to 2s, and the yield curve has to steepen, i.e. get less negative. And this is what actually the charts are showing you, is that we are no longer looking for lower yields, we're looking for basically high yields. I really would not be surprised to see the 5s, the 10s and the 30s, if the announcement is for more than 225 billion worth of coupons, to start taking out these levels around, this high here, around 406, 407, and slowly going to 428. Now, what does that give you on a yield curve of 2s 10s and 2s 30s? Well, it gives you basically around this 75 area, testing it, and on the 2s 30s, and let's make sure I don't actually press the wrong button this time, you're looking for somewhere around this 66 area. These are not huge moves, but they are important moves. And we will see later on when I show you what the impact on equities is going to be, that these are important moves, because if the 10s and 30s now start drifting higher in yield and ever higher in yield to discount the huge amount of auctions that are going to happen, and the 2s go nowhere, or they go 2, 3, 4, 5 basis points depending on data, then all that can happen is that the yield curve moves. So here you can see the yield curve. the current one in blue and the one 6 months ago here in red. You can see that the 2-year note is actually, 74 basis points higher. And why did I choose the 6 months ago? Because that is when Janet Yellen actually started undersupplying the market with duration. 10-year notes, 46 basis points difference. So you can see 74, 46, and in the 30s, 41. So you can see that the yield curve has moved by about 30 basis points between 2s and 10s, and another 5 basis points between 10s and 30s. I would expect that to be given back in its totality. So now we are stuck here in the 2-year note. It's going to go up and down 5-10 basis points. And the pressure, I think, now starts coming back on these sectors to start moving higher, with a proviso that basically coupons need to be higher than 225 billion. And that is going to change a lot of things for a lot of assets. Of course, we'll wait for the Monday and Wednesday announcements, but why do I think that that is more likely to happen than not? Well, if we have a look at the forward inflation expectations, they're not coming down, are they? This is going to remain sticky. And probably, if not it won't come down. That's what I'm really trying to get at. It might even drift up. And if we look at the term premium, it's so negative. There are many ways to calculate term premium, but this is one of them, and it doesn't really matter because comparatively they are more or less in the same place on this graph. Whether the term premium really is -70 or -40 doesn't matter. It just gives you a pictorial view of where it is. We've learned that JGBs are actually the best yielding 10-year note out there. And you have a pickup by buying JGBs as opposed to US Treasuries because of the very negative term premium. Well, if the issuance now gets upped and the market is no longer starved of duration, term premium has to return towards zero. I can't see any other alternative because none of the other things which enable term premium to stay low in the absence of issuance, and this is important. If we now get issuance, we remove the main plank that has been holding down the term premium into negative territory. And if term premium goes back up to zero, all it has to do is go back up to zero, which is, hardly a ridiculous thing to have. You're going to get a 30-40 basis point steepening in the yield curve. And that is quite significant. Basically, inflation is not going down. What the market is expecting in real yields is not going down. And therefore, I think the only path open on the back of greater issuance for the market is to take nominal yields higher. I won't show you the German curve and the individual tenures simply because that's as quiet as a church mouse and it will continue to do so. But what is interesting to me is the spread relationship. Now this is two Schatz, and as you can see, its volatility is coming down and down and down. It's basically in a 10, 15 basis point range, up, down, up, down, up, down, basically going nowhere. If you look at 5s, you can see that is slightly coming out, but 10s is much more coming out. And that to me says that if the issuance hits, right, if we get more coupons, we are going to go back up towards 172. I'm no longer, as I told you last week, a seller of this spread. I think the danger is reverting to higher on this spread, i.e. that the 10-year note in the States is going to be the worst performer of everything. I told you that I don't expect the JGBs to move. Too much risk in shorting JGBs now, especially at 57. I don't see that the Bund is going to be the one that gets hit. I think it's going to be the 10-year note. So this spread to me is likely to keep on coming out towards this 172 area. And that's another data point which gives me confidence that if we get supply above 225 billion of coupons, the market has no alternative but to start hitting the long end in the US. Well, DXY did exactly what was expected last week. False breakdown, interest rate differentials go out, the market is caught short down here, straight back up to this 101.90 level. And it's now waiting here. It's a very interesting juncture, because if I am right, not right, but if the coupon issuance is going to be high and that moves the yield curve, it's going to move the spread, as I showed you, against Germany, and it's going to move the spread against the JGBs. So it's going to make all of those markets yield less compared to the US. And that is going to be a very interesting juncture, because I think then the dollar probably starts rallying. And you can see where we are in the 200-day moving average, and everyone's bearish the dollar. And, if that starts happening, you want to start thinking that maybe the trend, this trend, is over. And now people need to buy dollars to fund the deficit, especially foreigners, and we start going up. It could easily be that we've seen the lows for the year. We will see, because if the deficit is going to get funded by coupons, rates have to rise. If rates rise, the dollar becomes more attractive. It's just logic. So let's see what happens. Let's see what the announcement is. And that's why I keep on saying that this announcement is going to move a lot of assets. Well, here we have gold, and it's not, what's happened here is that we've changed the front month, which is December now, I believe, and it's $30 higher on the spread to the previous front month. So everything has been moved up by 30 basis points. It hasn't gone up this week, as you can see. It's just that the basis has changed. So what is going on here? Not a lot, right? And I think that is waiting for it's waiting for direction as well from this QRA. I showed you before, just earlier, the charts of the real rates, which are slightly higher, and also the chart of the basis, but now the term premium. Now, if the term premium starts coming in towards zero, real rates are going to have to go higher, and to me that is actually gold bearish. I'm not a buyer of gold at these levels. I think that there are, better things to buy, but we will see. In any case, what is surprising to me is that this is actually indicating that it's time to buy gold against DBC. You remember that I've been bearish from up here, and that's moved a lot. That's moved, nearly 10%. As you can see, DBC is now breaking the 2440 level, which to me is bullish longer term. So I don't know why this dichotomy is here. I am doing nothing because of it. I'm not understanding what's going on. It could very easily be that DBC comes off next week, and that lifts the spread without gold going higher, i.e. DBC comes down more than gold comes down. But I just can't see any reason to buy gold in an environment where the dollar could go higher potentially, and and basically change the trend, and for real yields to start going higher, and for term premium to come in. That makes bonds more attractive than gold, and people should be selling gold, and it should be falling actually just as fast, if not faster, than bonds. So we shall see. I just am not a buyer of gold, and especially this kind of behavior suggests to me that we've probably seen the low in DBC for the year, and that therefore real yields can, and certainly nominal yields, can only go higher. If we go and have a look at what oil has done, okay, we still have the negatively sloping 200-day moving average, and we are at the top of a weekly range that I don't think will bust easily, this around this 82 area. What is more likely to happen than not, I would have thought, with oil, is that it comes back down towards 75, even lower, spits all the people out who got long up here, and then makes another move up. I just can't see that this is anything but bullish longer term. The fact that the market just cannot go and stay down in the 70s, to me, indicates that it's more likely than not to drift higher over the balance of the year. And that, coupled with the greater issuance, just tells me that lower nominal rates in bonds are very unlikely. Let's remind ourselves where we are on a multiple basis. On the Blue Angels, here we are, very close to times 20 forward, inflated forward earnings. Again, if I'm correct and the yield curve now starts steepening, i.e. goes less negative, the likelihood of us breaking times 20 starts becoming increasingly remote, because equities are expensive, relatively expensive to bonds at the moment, and if bonds start getting cheaper, this multiple, has to start coming down, or certainly not start going up. And that is why equities could, get hit in the next few weeks, simply because they are so rich to bonds, and bonds we will see, but it depends on the QRA. I just want you to be aware at how rich we are on a multiple basis. Forget about earnings, okay? Individual stocks like Apple will do what they will do, but earnings at times 20, are with the bond market going up in nominal terms and possibly in real terms as well, very, very difficult to sustain. So let's have a look at something like ITOT over government. So basically, this is the totality of the bond market against the totality of the stock market. Bond market, stock market relationship is clear ever since it broke these levels a couple of months ago when I told you favor equities. It's one-way street, right? But it's very overbought, it's very overextended. And now what could easily happen here is that you get a bond market where the yield curve steepens, and the long end starts going up. The multiples contract, because I showed you times 20 with nominal bonds above 4% is very rich. And then you get a 1, 2, 3 day very quick move down as people deleverage from their positions in equities. And then it probably continues. I don't think that there's any chance that the bond market will perform better than the stock market for any length of time. I may be just raising the possibility, and certainly if you look at SPY TLT, that this could come back down with bonds doing badly. So what I'm trying to say is bonds do badly, but stocks do worse for a 2, 3 day period. They come back towards a 440, 435 area. Everybody gets bearish stocks, and then stocks go up and bonds do nothing. I really don't think that bonds are going to perform better than stocks. I think the opposite is true. But I think that the stock market at the moment is rich, and the likelihood of some sort of an accident on the back of QRA is high. I'm not saying it's going to happen. I don't know what the QRA is going to be. I don't know how many coupons are going to be issued. But all I know is that if the coupon issuance is high, that is what's likely to happen. Okay, having said that, let's have a look at DJI. We're closing this month's candle on Monday. To me, this is absolutely beautiful. What is possible? Okay, I've just told you that the likelihood of I don't know, how would I describe it? Of a setback, of a temporary setback in equities on the back of the QRA is entirely possible, as they take out those overbought levels against bonds, and bonds do worse, i.e. equities do worse of all for a few days, is that we come back down to retest these levels, just short probably of this 34,600, and then we just zoom up into year end. That to me is the most likely, i.e. a continuation of this trend. And this area here, just north of 34,600, is an incredible risk-reward area. Just keep it in mind should anything happen. There isn't a single stock market out there that's looking bearish. This is stocks. I mean, it's closed on a new high. We're talking about 4,550 or higher. Then you're looking at the DAX closing at a new high. You're talking about a test here, 16,800 towards 17,000. Look at EEM. As I told you, this is the one to me to own. It's going to 42.25, no problem. And then somewhere around this 200-day moving average at 44.49. What could be happening is a rotation out of the US and into these markets, which would make sense. Let's have a look at Nikkei. I mean, it just does everything perfectly. It comes down to 32,000 of support, straight back up. Nothing here bearish. This is a bull flag. So longer term, this is going up. What I think is quite possible is that we get a nasty scare in all the markets next week, and then we go up. I am just not bearish stocks at all at the moment, but we will see. We'll see what the QRA is, and I might change my mind on on the back of it. But I certainly think whatever the QRA is, equities perform better than bonds. Let's have a look at my clean chart of the SPX, and this is really quite weird behavior. We had an outside day down, which is a very potent reversal signal, and then what do we do the next day? We go back up. This is going to be interesting because if we start putting together a few things, let's say the QRA is high, okay, we get a very high coupon issuance, say over 260-70 billion, and the 10-year and the 30-year go 20 basis points higher in yield. Well, you could easily get a big move in equities over the course of 2 or 3 days, which basically fills this gap all the way down to, I don't know, 44.20 or something like that. And then you get the primary force of the equities outperforming bonds taking over from these kind of levels. Entirely possible, entirely possible. I just know that next week is going to be quite volatile and that I really want to know what the exact breakdown of the coupon issuance is before I make up my mind and do anything on the yield curve or in equities. But I know that I'm a definite better buyer of equities at lower levels compared to bonds. So absolutely no point in doing anything sizable in the market until we know what the QRA is going to be and most importantly, the size of the coupons. If this is, I don't know, 30, 40, 50 billion higher than the market expects, I think bonds and equities respond down and eventually equities stabilize at the levels that I showed you, and then we start going back up again. These levels are to me going to be very, very interesting. I don't see it going through there, and that's going to be a shock to the market, right? If we get anywhere near these levels, I think the volatility is going to be enough to get us there. And, that's where you start doing some sizable call options, especially in the Dow, because I think that is so clear that it's going to rally very hard from the levels that I showed you. Anyway, that's what we have. Just wait for the QRA, and then everything will become a lot clearer because bonds will be in the driving seat. Thank you very much indeed, and tweet you tomorrow.